This is Nightly Business Report with Bill Griffith and Sue Herrera.
Wall Street sell-off, stocks tank as Apple feeds into some of investors' biggest fears of a global economic slowdown. $74 billion bet. Bristol Myers Squibb is buying Celgene to create a cancer drug powerhouse. But that's not the only reason for the get-together. Power shift. A new Congress is sworn in. Ending the partial government shutdown, though, tops the agenda, but there's still no end in sight. Those stories and much more tonight on Nightly Business Report for this Thursday, January the 3rd. And we do bid you a good evening, everybody. Sue is off tonight, and what a night to be coming to you once again here from the New York Stock Exchange, where it was another rough session for stocks. It started last night with that rare revenue warning from Apple that we told you about. The company blamed China, sparking new concerns of a global economic slowdown, and those concerns then reverberated in the markets around the world in the last 24 hours. The selling then intensified here on Wall Street when a new report this morning pointed to a decline in factory activity in December. And as one strategist put it, that report shows that the slowing growth overseas may have made it to our shores. Here are the day's closing numbers, with the Dow closing on its low of the day, down 660 points to 22,686. The NASDAQ was down more than 200. That tech sector overall had its worst day in 7 years, and the S&P 500 slid by 62. By the way, Apple dropped nearly 10%, suffering its biggest one-day decline in 6 years. The company that was once the most valuable in the world has lost nearly 38% of that value since early October. Mike Santoli has more on today's Stock Slide.
One of the world's most important companies has confirmed one of investors' greatest fears, that the global economy is slowing sharply, with China and the trade war near the center of the weakness. Apple's warning of a steep shortfall in revenue for the latest quarter, mostly due to poor iPhone sales in China, punished the company's already battered stock and drove selling in a wide range of shares exposed to the sputtering Chinese economy. Semiconductor, aerospace, and industrial goods stocks bore the brunt, dragging the broad market lower on the year's second trading day. Fear that the U.S.-China trade standoff is hurting the global economy has been a key factor driving the three-month 15% sell-off in the S&P 500. And these concerns were amplified in a weaker-than-expected report on U.S. manufacturing trends on Thursday. The ISM report is a closely watched gauge on industrial conditions, and its sharp pullback added to growing worry that corporate profit forecasts for 2019 will need to be cut significantly. Many strategists came into the year saying stocks appear attractive after their recent decline, valued near a three-year low compared to consensus earnings expectations for the coming year. Yet this is based on current projections of about 7% profit growth. If that number needs to be cut substantially, stocks wouldn't necessarily prove so inexpensive. Then there's the larger debate on whether the chances of a U.S. recession in coming quarters is rising appreciably due to all these issues. The bond market has been dropping Treasury yields in a way that hints at rising recession concerns. Yet consumer spending and employment numbers have held up quite well. For all these reasons, investors are awaiting Friday's jobs number and the coming flood of earnings reports later this month with a mix of eagerness and caution. For Nightly Business Report, I'm Mike Santoli.
Certainly, Apple's rare earnings warning has left many wondering just how bad it's going to get this earnings reporting season, and who could be next, if any. Phil Blancato is the CEO of Ladenburg Thalmann Asset Management. He joins us here at the New York Stock Exchange tonight. Happy New Year. Good to see you.
Good to see you as well.
Do you sense at all if this is a specific problem to Apple, or is this a broader issue that's other companies are going to suffer from as well?
Remember, this is a bad movie second time around. In October, when they did this, it was the first sign that really the market was changing, and it did, and we sold off since then. Then we got to this moment of capitulation at the end of the year, and we thought maybe we were okay, and here comes Apple again and does it to us again. So for me, this is still an Apple issue because there's two things going on there. First, they're transforming as a company. They're going from a manufacturer of technology to a company that's service-oriented. And that's going to slow, painful transition. But they still have a very powerful brand. Secondarily, there is this tariff issue, and it is affecting the cost of their goods, and it is impacting their revenue, specifically in China.
And other companies we've heard about, like a Caterpillar or a Boeing, have been poster children as well for the trade tiff with China.
For sure.
Do you think other companies like that will have problems as well?
I do, whether it's a Delphi, and you mentioned the Boeing, that's sort of my poster child. When you think about This weakening of the biggest plane market in the globe, or one of the biggest, suddenly buying less planes, having less consumer-driven traffic, buying less manufacturing from us, that's a problem. And that's where the tariff really hits home.
The issue, whether or not the slow growth in China has reached our shores. What about our earnings season coming up not too long from now for the fourth quarter? What do you expect to hear?
I take the other side of that one. You know, you got to play the averages, just like baseball a little bit. Sure, 25% earnings growth last year was awesome. So now we're going back to average. Maybe it's 10 instead of 12. That's still growth.
But is that priced into the stock market yet?
It is. I do think it is. I think we've got to this moment where the market has been far oversold. And you're looking at a scenario, if the Fed becomes somewhat accommodative, you've got a very powerful consumer. Full employment, wages increasing, low inflation, low interest rates. These are the signs of a strong consumer that should support us.
A lot of people out there wondering, so what do I do about it? What do you say to the average investor then?
So take your time right here. You want to rotate the cash or bonds just to let this volatility soften out a bit, that's fine. Let's see where the Fed sits between now and March. However, there is going to be an opportunity to buy into the stock market here because I think earnings are going to grind higher.
Are you going to buy growth or are you going to buy defensive issues, which became very popular last year?
Great question. I'm not in the defensive camp yet. I don't think we're on the cusp of a recession. You hear a lot of that. But you and I grew up with runaway inflation, runaway interest rates, runaway wage. None of that exists today. Where's the exuberance in the economy? So if that's not there and we got a strong consumer, it's not time to be defensive yet.
Who are you going to buy? Technology? Are you ready to buy an Apple or any company like that yet?
I'd start with the consumer discretionary, and then I'd work my way into the healthcare sector, which is a staple of where we're going, and the technology sector eventually. And at some point, I'd keep an eye on the banks. Wow, have they been hit hard? Not yet. But let's see if we get a leveling off here. Maybe get a little bit of loan growth later in the year because we get some turnaround. That could be a second half of the year story.
Always wise counsel from Phil Blancato of Ladenburg Thalmann Asset Management. Again, Happy New Year.
Happy New Year.
See you later.
Appreciate it.
Take care. Elsewhere, White House economic advisor Kevin Hassett today said a lot of U.S. companies that do business in China, not just Apple, could feel the pain of a slowdown in the world's second largest economy.
I speak regularly with people at Wall Street, and this is something that people have been seeing coming for a good long while. And it's one reason why, and you could go back and look at my TV clips in December that I was saying that, you know, yes, the Chinese economy is slowing, and one of the reasons why markets are responding the way they are is that people are downgrading their earnings forecast for folks who have a lot of business in China.
As you know, trade tensions between the U.S. and China are high right now, and adding to the economic strain today was a travel advisory from the State Department saying that Americans need to exercise increased caution when traveling to that country. Well, even if you don't own Apple shares outright, there's a good chance that you own some in an exchange-traded fund or an index fund or even a mutual fund. Vanguard right now is the largest institutional shareholder in Apple, mostly through its index funds and ETFs. BlackRock and State Street are also among the top holders in Apple. In fact, those three firms combined suffered paper losses of about $10 billion just today. And remember, Warren Buffett's Berkshire Hathaway took a big stake in Apple last year, and today its paper losses came out to be roughly $3.5 billion. Meantime, the head of the Federal Reserve Bank of Dallas says it's time for the central bank to hold off on interest rate increases. During an interview earlier today, Robert Kaplan said the Fed should not take any further action until some of the market and economic uncertainties resolve themselves. He added that that could take several months, so he feels policymakers should keep an open mind about the timetable for further increases. There was some positive news on the economy today, and it involved jobs. A report on the job market showed that the private sector added more jobs than expected in December. The ADP private payroll report rose by 271,000, its biggest gain since February of 2017. And tomorrow, of course, the government issues its own monthly jobs report, which is widely followed by many market participants. Well, despite the concerns that the economy may be slowing, auto sales continued at a strong pace last month. In fact, the numbers in December helped the industry post surprisingly solid sales for the whole year. But can that continue in 2019? That's the big question. Phil LeBeau takes a look.
Whatever worries analysts may have about America's economy cooling off, auto dealers are not seeing it in showrooms. December sales did drop compared to the same month in 2017. But overall, business was robust, with sales climbing slightly higher in 2018 topping 17 million vehicles for a fourth straight year. That has never happened before. Will it continue? There are mixed signals. The jobs market and consumer confidence remain strong, and relatively cheap gas means Americans have more money in their pockets. They are also taking out larger and longer-term auto loans. That's because they're paying more than ever for a new model. So there's concern consumers may be at their limit, especially with a wave of 3- and 4-year-old models coming off lease. That gives buyers the option of paying far less for a car or truck with low miles and most of the latest technology.
The worry is this industry for 2019, for the first time in a decade, doesn't grow.
One thing is not expected to change for automakers this year. Trucks, SUVs, and crossovers will remain in demand as Americans continue to move away from driving small cars and sedans. Phil LeBeau, Nightly Business Report, Chicago.
A blockbuster deal in the drug industry to tell you about. Bristol-Myers Squibb is buying Celgene for about $74 billion, making this the first major deal of 2019. Shares of Celgene soared by 20% today, while Bristol-Myers Squibb went in the other direction, dropping by 13%. The focus of the combined company will be cancer treatments, but as Frank Holland reports, that's not the only reason for the tie-up.
Bristol-Myers Squibb is bulking up. Its acquisition of Celgene will create a dominant pharmaceutical company with a focus on cancer treatments, but both companies face a number of challenges, and that may have been the real driver of this deal.
I don't see this as really a deal that is driven by enthusiasm, excitement on either end. I think it's really, two mature companies with, consolidation benefits. I mean, they have a lot of overlap in terms of their R&D and sales force. I would expect a lot of that to get eliminated, and I think that's what's really driving the deal here.
The companies say the deal will create $2.5 billion worth of savings by 2022 and increase profits by roughly 40% next fiscal year. Those cost savings come as Bristol suffers a series of setbacks in the development of new drugs. It's also facing stiff competition from Merck's oncology drug Keytruda. Celgene will lose patent protection for its best-selling drug by 2022 and has endured a number of clinical trial setbacks. Celgene shareholders will receive Bristol-Myers Squibb stock and cash, giving them a premium on Celgene's closing price on Wednesday. BMO Capital Markets analyst Alex Arfe called the deal expensive but logical in a letter to investors.
The rationale is complementary portfolios in oncology, inflammation, and cardiovascular disease, a promising pipeline, and cost synergies.
The merged company will have 9 products worth more than $1 billion each in annual sales. Management says the combined company will create a pipeline of potentially profitable drugs in development with 6 near-term product launches that could deliver more than $15 billion in revenue potential. But experts say it all depends on how these drugs come forward and if they get to market. Shareholders from both companies and regulators still have to give final approval of the deal. If that happens, Bristol-Myers Squibb's acquisition of Celgene is expected to be completed by the third quarter of 2019. For Nightly Business Report, Frank Holland.
Time to take a look now at some of today's upgrades and downgrades. We begin with Alphabet, which was upgraded to a buy from hold at Canaccord Genuity. The analyst there cited the potential for 15 to 20% revenue growth and declining margin pressure. Price target now $1,250, and that stock fell along with the broader market today, down more than 2.5% to $1,025.47. Gilead Sciences was upgraded to outperform from perform at Oppenheimer. The analyst cited the drug maker's new CEO and the company's prospects for growth as a result. Price target $85. Shares rose more than 2.5% today to $65.25. And Dow component United Technologies has been rated a neutral at Citi in new coverage. The analyst says the stock lacks a near-term catalyst, making it tough for the stock to outperform. Price target now $120. Shares dropped 4% today to $103.48. Still ahead, cooling off. A once hot real estate market has its worst years since the financial crisis. The concerns about a slowdown in China spread today into the luxury retail sector. The feeling is if Chinese shoppers are not willing to spend on an Apple iPhone, then they may also put off purchases of luxury goods overall. Over the years, China has become a growing and lucrative market for many high-end brands. But analysts today say that's why companies like Ralph Lauren, Tapestry, and Tiffany all traded lower today. A power shift in Washington with the 116th session of Congress beginning today. Democrats take control of the House, and this divided Congress starts work with a very long to-do list. Ilan Mui reports for us tonight from our nation's capital.
Nancy Pelosi, now officially Speaker of the House for the second time, the only woman to hold the gavel. She arrived on the House floor today with her family, her 5 children and 9 grandchildren, and she called for common ground amid divided government.
We have no illusions that our work will be easy and that all of us in this chamber will always agree. But let each of us pledge that when we disagree, we respect each other and we respect the truth.
That bipartisan spirit might not last very long. On the Democratic agenda, new rules to automatically raise the debt limit whenever a budget gets passed, reform campaign finance and voting rights laws, and protect the Affordable Care Act. But first, a vote to reopen the government. That will happen in the House tonight, and the bills don't have any money for President Trump's border wall. Senate Majority Leader Mitch McConnell said the Democrats' effort is dead on arrival.
I've made it clear on several occasions, and let me say it again. The Senate will not take up any proposal that does not have a real chance of passing this chamber and getting a presidential signature. So let's not waste the time.
Negotiations over the shutdown will resume tomorrow. The White House will meet with congressional leadership from both parties. On Capitol Hill today, Vice President Mike Pence told reporters there's a crisis at the southern border.
We're going to continue to engage Democrats and Republicans to come together and to achieve the kind of agreement that will provide the border security that the American people need. And that means a wall, that means a physical barrier, but it also means a broad range of border security measures that will make our country more secure, that will prevent the flow of illegal drugs, illegal immigration, human trafficking.
But here in Washington, the reality is sinking in that this shutdown is going to be measured in weeks, not days. For Nightly Business Report, I'm Ilan Mui in Washington.
Delta loses altitude, and that's where we begin tonight's market focus, with the airline saying it is not able to raise fares as much as had been expected, and it warned as a result fourth quarter unit revenue will be slightly below its prior forecast, and that's creating concerns that the major carriers will struggle to maintain profitability this year. Delta shares were off nearly 9% today to 45.61, and the news sent shares of other airlines lower as well: American, United Continental, and Southwest. Starbucks is facing stiffer competition in China. Chinese coffee startup Luckin now plans to open 2,500 new stores in an effort to overtake the number of Starbucks locations in the world's second biggest economy. Shares fell more than 4% on Starbucks today to 61.53. Consumer products giant Johnson & Johnson said today that sales in India fell by 3% over the past 12 months. J&J, of course, has been grappling with that country's stringent medical device pricing policies, and the controversy surrounding its talcum powder has prompted safety inspections all across that country. J&J shares fell more than 1.5% today to 125.72. And generic drug maker Teva said today that it's going to pay an undisclosed amount to settle a patent infringement dispute with drug maker Amgen over one of Amgen's treatments used for chronic kidney disease and parathyroid carcinoma. As part of this settlement, Teva will stop selling that drug until 2021. Teva recently won approval, though, to market that medication in the United States. Teva shares rose 4% today to 16.49. Shares of Amgen fell more than 1% to 188.98. The volatility we've been seeing in the equity markets is causing some to stay on the sidelines when it comes to making other large investments, namely real estate. And there's no place that trend is more pronounced than in New York City right now. With that market, they're coming off its worst year in a decade. Robert Frank reports.
Manhattan is going through 2 big corrections. the stock market and the real estate market. The fourth quarter saw sales of Manhattan real estate fall 14%. It was the fifth straight quarter of declines and made 2018 the worst year for Manhattan apartments since the housing crash a decade ago. Volatile markets are one cause, but buyers have been staying on the sidelines for over a year, due mainly to an oversupply of new condos, especially at the high end, a lack of foreign buyers, and the new tax law, which makes real estate in high-tax states like New York a lot less attractive.
It really was a wet blanket that has essentially laid over the market. Consumers, when they are confused, they pause, and that's what buyers are doing.
Inventory is growing, discounts are getting steeper, and there is now a 16-month supply of luxury real estate. But if Manhattan is now a buyer's market, it's still a wealthy buyer's market. The average price of a Manhattan apartment is still just under $2 million. The big question is, how much worse will it get in 2019? That may depend on the stock market, which affects the buying confidence of the wealthy, as well as the New York hiring plans of tech giants like Google and Amazon.
2019, if we had this conversation a year from now and the stock market continues to be as volatile as it is, I would expect pricing to be softer than 2018 and sales to be less than 2018.
Now, the most expensive sale in 2018 was a penthouse on Park Avenue that went for $74 million. It's close to 10,000 square feet with 6 bedrooms and a 300-foot balcony. The buyer was vacuum cleaner tycoon James Dyson, whose flagship Dyson store is just a few blocks away. For Nightly Business Report, I'm Robert Frank.
Speaking of which, in other real estate news, office vacancy rates here in the U.S. inched higher in the fourth quarter. According to a new report, new construction of office space declined in the last 3 months of the year, but rents, which have been relatively steady over the last 8 years, they were up about 3%. Coming up, help wanted in the oil patch.
I'm Jane Wells in Deer Park, Texas at a Shell oil refinery. Yeah, oil prices are low, and yet the help wanted sign is out here for women. We'll have that coming up.
Here's what we're watching for and what should be another busy day tomorrow. As we mentioned, the monthly employment report will be released. Expectations are for creation of about 176,000 jobs in December. Fed Chief Jerome Powell will speak at the American Economic Association's annual meeting, and former Fed chairs Janet Yellen and Ben Bernanke will be there as well. And the president and congressional leaders are expected to meet to discuss the partial government shutdown and border security once again. And that's what we're watching for on Friday. Well, the price of oil may be down, but hiring in that industry is up. And as we've been reporting many times, energy companies are having a hard time finding skilled workers. That means more women are closing the gap in this traditionally male business. Jane Wells is in Deer Park, Texas for us tonight with the story.
Afternoon, everybody.
Christina Smith is a mother of 3. She used to manage a Subway sandwich shop, worked at a commercial dive store. Then she went back to school, got a technical degree, and now she's a shift supervisor at a Shell plant in Deer Park, Texas, making good money.
My dad's exact words were, "Kid, you hit the jackpot."
The petroleum industry estimates only 15% of its workforce is female, and only about half that number reach the executive level, like Lori Freeman, a general manager in the Gulf of Mexico.
I personally set the bar high for myself, so a lot of the challenges that I think I went through were actually challenges that I had set for myself.
Now, Big Oil is going big on hiring more women. Helping them is industry veteran Katie Maynard, who vividly recalls a remark made by a man sitting next to her on a flight to Houston.
And he said to me, "What's a pretty young lady like you doing in a dark, dangerous business like oil and gas?"
She decided to create Pink Petro, a for-profit company funded by Shell and others to reach out to women who may have never even considered a career in energy.
The outreach to women is happening as oil prices are falling, which is providing an extra challenge to an industry with an aging workforce that really needs a new generation of workers, male or female.
We need to think about the marathon. It's not a sprint.
I'm 40 now, but I don't remember growing up somebody saying, why don't you go work at the plant? Or you could be an engineer, or, you know.
Some of the women mentor each other about opportunities and the challenges, like not always being recognized as a senior engineer.
When I walked in the room, a person asked if I could put their coat up.
But that's happening less and less.
I work hard, I want to learn, I like to help people, and because of that, I feel respected.
In the end, why recruit women? In an industry needing a pipeline for a next generation workforce, the answer may be, why not? For Nightly Business Report, Jane Wells, Deer Park, Texas.
And before we go, a final look at the day on Wall Street. Another big sell-off today. The Dow fell 660 points. The low of the day, the Nasdaq was down over 200. The S&P slid by 62. And Apple dropped nearly 10% today, suffering its biggest one-day decline in 6 years. That is Nightly Business Report for tonight. I'm Bill Griffith. Thanks for joining us. We'll be back here again tomorrow night at the New York Stock Exchange. Hope you can join us then. We'll see you tomorrow.